Hey everyone, this is Andrew from Dividend Growth Masters, and today I want to talk about Warren Buffett and specifically how we can apply some of his principles to become more successful at dividend investing. So I've followed Warren Buffett since college. I've read a ton about his life and his business success. And Warren Buffett is pretty much the greatest investor of all time. He's beaten the market over multiple decades, and we can all learn a lot from his investing philosophy. And we can do this because he shares a lot of his secrets through interviews, shareholders' letters, and a lot of other sources. So how can we use this to become more successful at dividend investing? Well, if you look at his portfolio, Warren Buffett actually owns a lot of classic dividend stocks like Coca-Cola. Alright, let's get started. These are seven Warren Buffett secrets that can be directly applied to dividend investing. The first is buying high-quality businesses. Warren Buffett is all about buying high-quality companies. In fact, he's even been quoted to say something along the lines of, "It's better to buy a great business at a fair price than a good business at a great price." It's all about quality and quality only. Dividend investing is by definition long-term investing. We only want high-quality businesses that can continue to pay and increase dividends over multiple decades. If it's not a high-quality business, we don't own it. Simple as that. The second secret is to be patient. Patience is a virtue, especially in the investment world. Warren Buffett is known to be incredibly patient. In fact, legend has it he waited decades to buy Dairy Queen, which is one of his favorite restaurants. He waited decades to buy that restaurant at the right price. Dividend investors also need to be patient. You're not going to be able to retire off your dividend portfolio overnight. It takes a lot of time to be able to increase your dividend income and to build a well-diversified portfolio that will last through retirement. The third is long-term holdings and a long-term horizon. These days, investors are known to be short-term holders or renters of stocks. Investors rarely look more than 1 or 2 years out into the future when buying a stock. Some even try to trade around quarters to try to get a short-term pop in the stock price. Warren Buffett doesn't do this, and neither should you. Long-term investors have one huge advantage over short-term investors, and that's time. Time is truly the ally of great high-quality businesses. In the short term, a stock can underperform for a variety of reasons. They might be going through a management change, the company might have botched a new product launch. However, if it's a high quality business, the market will recognize it in the long term, in 5 or plus years. The fourth one is businesses with long corporate histories. Warren Buffett owns some of the greatest American companies of all time. The list includes Coca-Cola, IBM, and a few other ones. So, what do all these stocks have in common? Well, they've been in business for a long time. Warren Buffett knows that businesses with long and successful track records have a history of excellence. You don't stay in business for 3 decades reporting crappy results. And yeah, I know, past performance is no guarantee of future outperformance. However, I'd rather own a stock that has a long history of strong performance than a stock that is expected to turn around. The fifth is diversification. Keeping a well-diversified portfolio is incredibly important for your financial health. Put too much money into one stock, and you might be going under if one of your larger holdings collapses. Warren Buffett keeps a relatively diversified portfolio. He owns industrials, utilities, retail companies, consumer staples, and even energy companies. Diversification is incredibly important because it smooths out the volatility in your portfolio. While one industry may be doing bad, another one might be doing good and offset those losses. The traditional example of this is airlines and oil and gas companies. If the price of oil collapses, oil companies are going to get hit hard. In contrast, airlines, whose largest expense is jet fuel, will benefit from the lower input costs. If you just own oil companies, your portfolio would get hit pretty hard, but if you own both, your portfolio would partially offset itself. The sixth thing we can learn from Warren Buffett is to keep things simple. His investment strategy is very simple: buy great companies at fair prices and hold them forever. The dividend investing strategy is simple too. We just buy stocks that can pay and increase dividends over multiple decades. The harder an investment strategy is to understand, the higher the execution risk. Dividend investing is one of the easiest investment strategies to follow. Keep it simple and you'll succeed. The seventh and final Warren Buffett secret is invest in what you know. One of Warren Buffett's most famous quotes is to stay within your circle of competence. So what does that mean? He means you should only invest in companies and businesses and industries that you know and understand. That's why Warren Buffett has largely avoided companies in the tech and software industries. Personally, I avoid stocks in the biotech industry because they're very volatile and I really don't know what they're doing, especially the drug manufacturers. Never invest in a stock or company if you don't know what is going on. Sure, you might miss out on some great returns down the road, but more often than not, you'll save your money from big losses as well. Alright, these are the 7 Warren Buffett secrets that you can definitely apply to your dividend investing strategy to become more successful. If you like this video, leave a comment or share the video. And be sure to subscribe as well to get my upcoming videos. I'll also include a link in the description for my website and my online courses. I would definitely check those out if you want to learn how to make more passive income online or if you want to get started with dividend investing. Alright, thanks guys. I'll see you next time.